Welcome to this week's Credent Connect series. And today we're back on markets, economy, investments, discussing things that are kind of dominating the media here and there. And what we want to address today is the fact that we are now past the debt ceiling debates and all of the media debacle we had kind of heard. The reality is when we last spoke about this back in May, would have been or so, we addressed the fact that the inability to raise the debt ceiling would have caused tremendous sentiment-based volatility in the markets. Such a rhetoric generated fears on debt defaults. It generated fears on the ability of the dollar to lose its stature in the global financial system and global trade, all of which we did believe was a little overblown. And in fact, we wrote about it and discussed it extensively that this is likely to pass, given that the way government debt works is not necessarily how household debt works. Now that we're past that, kind of what we want to talk about next is the notion of what's next, right? What is the market going to focus on next? What is the media going to focus on next? And one of the things that really still stands out, kind of things I want to talk here with Alisha, is the notion of the consumer, right? What drives consumption? Consumers, obviously, income, labor market updates, and the such. Alisha, can you give us a sense, kind of as we look at the next big thing, for lack of a better term, what is the next big? What should we be paying attention to as a driver for a tailwind or headwind or what have you?
One of the things that we're focused on right now is just the earnings outlook. So as we look at earnings in Q1, all of those earnings are finally coming in. And what we've seen is that earnings have come in quite a bit better than what we had anticipated. Going into earnings season, the consensus was a negative 8% decline in earnings. And what happened was we actually only had a negative 3% decline. So that earnings recession that everyone has been talking about is actually coming in a lot better than what we had forecasted. And then when we're looking at revenue also came in better. And actually the net income compression is winding down as well. So we're seeing inflation coming down. We're seeing the cost-cutting efforts that took place starting to work through. And so forward-looking, those estimates are actually improving, which is really going to support equities.
Yeah. You mentioned inflation. One of the things I think it's important to note for investors is the Fed's efforts in lowering inflation are to lower the rate of change of rising prices, not to lower the absolute dollar amount of how much a cup of coffee costs or a car or things like that. The fact that we are seeing that compression in the rate of change with sustaining incomes and better than expected earnings profiles in a lot of these companies, those are all positive things across the markets, across the economy, things that are being slightly overlooked as of right now, which is kind of unfortunate, to be honest with you. Alisha, you mentioned on the consumer front, give us a little update on the labor market, kind of job openings, things like that. I know we've talked about GDP, we've talked about output, employment. I want to touch on that, but talk us a little bit about non-farm payrolls and maybe just kind of the labor market in general. How's that look?
The labor market is exceedingly resilient. You think about 500 basis points of interest rate increases over the last 13, 14 months, you would think that we would see a lot more deterioration. And we've seen a little bit on the edges, but overall it's been very, very strong. So when we look at unemployment, it's at 3.7%, very, very low on historical standards. When we look at job openings, we had over 10 million job openings in the month of April, which is phenomenal. That's 1.8 open jobs per unemployed worker.
Yeah.
Very, very strong demand for workers. In addition to the most recent non-farm payroll report came in, 1.5 times what was expected. And so we're seeing economists being, neutral to pessimistic, but we're seeing the data come in exceedingly strong.
Yeah, the economic surprises have certainly built a potential picture for a melt up, right? Not really a term you hear often. You hear melt down often, but the melt up scenario is certainly building in that regard. On the notion of labor market, one of the unique things that's happened this quarter, or rather this year, that we haven't seen much in the past, is seeing employment outpace output. What we mean by that is we're seeing kind of a steady global, or rather gross domestic product growth with a slightly declining to neutral income backdrop on gross domestic income. This is quite unique, to say the least, and it showcases the resiliency of the labor market to be able to sustain what may be a potential recession over the next year. And I don't think investors should hide from that, because the reality is recessions are part of a normal business cycle. What we are seeing, however, in Alisha's earnings data that she mentioned in the labor market update, certain segments of the economy have certainly dipped into their own recession as we speak, while others have avoided it tremendously. That kind of dichotomy, that shift is likely what's going to shape the next recession, so to speak. It's going to come in waves by industry, by sector, by segment. And we believe the overall impact to the aggregate economy, and therefore the markets, to be notably more neutral than things we've experienced in the past. Thank you.